Welcome to part 2 of the life insurance exam review notes that I've shared on YouTube. Thank you guys so much for encouraging me to do a second video. I had always intended to do it, ended up getting sick, and so glad that y'all kept pushing me to do this because I really want to help the right people get into business. All right, so we're going to dive back in where I'm going over my notes in depth, and I'm going to do a shorter video that'll give you like the key points. So look out for that video. I'm going to make that one too. And I want to encourage you, if you need a little extra study help, check out my notes. They're on my website, thepurposefilledwoman.com. Go to the shop, look for life exam review notes, and they'll be there. And they're really easy to print. I'm going to show you guys. I formatted them to be printer friendly, easy to memorize, and straight to the point. So I pray that that helps you. So we're going to dive back in where the last video left off. We're going to talk about legal interpretation. So there's certain words in insurance that might mean something different than if you're used to seeing them in banking or if you've seen them just in general life, that can trip you up if you don't memorize them the way the book wants you to memorize them for the test, or the way that your test prep course wants you to memorize them. I want to remind you guys that this video will not substitute your state required test prep. So whatever class, however many hours, you want to go through that process before you take your test. This is just a review of notes that I've used, that I passed the first time, but also that I've used for hundreds of people in 6 different states to pass this test. So I know that these notes work. And so I'm gonna take a deep dive into my review notes. But of course, if you guys need anything, if you have any questions, email me, thepurposefilledwoman@gmail.com. And of course, you can check out the notes that are on the website. All right, so some words that I want you guys to know for the exam and memorize them the way that the book wants you to understand it. So don't use your common sense on this test. That's one thing. I've always found the smartest people fail the exam because they're thinking it. Don't think it, memorize it, and keep rolling. And there are going to be certain things on this test you're going to feel like this is dumb. Yeah, some of it sounds dumb as hell. It's legal. Okay, memorize it the way it is, keep rolling, because you only have to pass this test one time and continue with your continuing education, and you'll be in business. And that's all that matters. And so reasonable expectations is one of those words that you want to remember, one of those concepts. And it's basically that if you think about it, if an insurance company advertises that we take care of people with pre-existing illnesses, a passerby can reasonably expect coverage based on that advertisement. And so the back of the sales brochure might have some specifics that say not all people are covered, but reasonable expectations means that based on your advertising, I can reasonably expect coverage. And this can be implied, it can be in your sales literature, it can be a statement that an agent makes, anything like that sets up that expectation. And then indemnity, here's a key one. Indemnity means to make whole or to reimburse. And I always like to think about it like this. Anybody like donuts out there? Think about a donut, right? It's whole. Well, if you get into a car accident and there's a bite taken out of it, right? You lose some money because your car is now undervalued. You lose some money because it has to be repaired. You lose some money because you are off from work, you're injured, right? All these things make your donut no longer whole. The insurance company says, I'll fill that gap, all right? So that's indemnity. Indemnity means to make whole. You cannot profit from the loss. You can only get back what you lost. So if your hole is this big in your donut, that's how much money you're getting back. If your hole is this big in your donut, that's how much money you're getting back. But think about it in terms of restore. So indemnify or indemnity, think about make whole, reimburse, restore. All those keywords will help it stick in your brain. You are not allowed to gain financially. And then another set of words is representations and misrepresentations. In insurance contracts, representations are statements that you believe to be true to the best of your knowledge, right? So I am healthy to the best of my knowledge. And so those types of answers that you're giving in your application, on an insurance application, they are considered representations. Misrepresentations are things that you are saying that are not really true. And a material misrepresentation is anything that you state that it would interrupt or it would change the way that you're being underwritten. So anything that would change underwriting is a material misrepresentation. If it is intentional, So an intentional misrepresentation is fraud. Warranty. A warranty is a statement that is absolutely true. And because of that, the only people that are really held to warranties are the insurance company. The only body or the only party in the contract that's really held to warranty is the insurance company, because it is absolutely true. Concealment is another term. That's intentional withholding of information from the company. Any material fact. So if you withheld a material fact, like you needed to have some tests done to determine whether or not you had a certain disease, but you didn't go get that test done, and you don't tell the insurance agent that that test has been ordered for you. So that's a concealment. It's intentional withholding of information of a material fact that's critical. Utmost good faith is another principle where both the insurer and the insured, or the potential insured, the applicant, both are coming to the party and saying, we are doing our best to be upfront, totally honest, there are no tricks. Fraud is the intentional misrepresentation or intentional concealment of a material fact. All right. So let's move right along, and we're going to talk about some basic concepts of life insurance. And there's some key terms in here, especially about the people who are parties to the contract, that I think are good to remember. So think about life insurance as being an insurance that is purchased for businesses or individuals' use, and they cover a life. So the life insurance covers a human life. So let's talk about insurable interest. Insurable interest means I lose something if this person dies. So as much as I might like a particular artist, or as much as I might be in love, with an ex, I can't get life insurance on that person if I don't lose something if they die. And so you have insurable interest in your own life, your spouse's life, your child's life, a family member that you take care of, or a family member who is responsible, you are responsible for, a blood relative, a business partner, a key employee on your staff. All of those places, there is a financial loss had if that person dies. Somebody who's in debt to you, there's an insurable interest. So if you are the bank and you loan $300,000 to Tyra, and Tyra passes away, Tyra can't pay you the $300,000. So as the bank, you have an insurable interest in Tyra's life. So let's talk about personal uses of life insurance. And I think one easy way to remember is SECLE, S-E-C-L-E. Well, number one, personal use is survivor protection. If I die, my kids need this money. Survivor protection. Number two is estate creation. Estate creation. So life insurance creates an immediate estate because you went from not being worth anything to now if you die, your survivors get a lump sum of money. So there's an immediate estate created by life insurance. And then C, cash accumulation. Now, this only applies to your whole life and your universal life policies. So don't forget, cash accumulation is only for those policies that have that savings account attached to them. Liquidity. It goes hand in hand with cash accumulation because that cash is liquid. It is accessible. You don't have to sell off a piece of land or something. There's the liquidity there. Now, remember with cash value or whole life insurance, that cash account is really available for you to borrow from. It is not just sitting there that you have access to. It is a loan, and you pay yourself back plus interest. And the E stands for estate creation. That's estate conservation. I'm sorry, y'all. Estate conservation. Excuse me. So let's talk about life insurance creates an immediate estate. That's one aspect. Then you have the estate conservation, the second E, the last E on SECLE. Estate conservation means that you're protecting the estate that you created. So let's say by the time I pass away, I have hotels, apartment complexes, I have stocks and bonds, I own some property, some land that's being leased out. And so when my family has to pay the taxes on all that stuff, they might have to sell off some assets to protect what I built. But if I have enough life insurance, that can be paid off without them liquidating any of the assets. So they can pay those taxes without liquidating the assets. And that conserves the estate. So think about conservation as conserving something. All right. Life insurance proceeds may be used to pay inheritance taxes and federal estate taxes. All right. So just remember that piece. You want to have enough life insurance that your family can pay those things without having to sell off any of the assets. All right. So there are a couple ways to determine the amount of life insurance that a client needs. One is called the human life value approach. We can't really put a dollar amount on life, but we can estimate how much money a person will earn in their lifetime. And so this is what you call the minimum amount needed, the human life value approach. It's replacing the income only. Basically, you calculate the person's income during the working lifetime. And then you compare wages and inflation before retirement. And then there's the needs approach, This is where you're taking into account a person's debt, the cost of their death, right? The cost of burying them, the income that their family might need, those types of things, emergency needs, education funds, bequests to different churches and charities that they love. And you put all of that together. And that's the needs approach to life insurance. Now, there's a thing that you need to do with your clients called planning, right? When you sit down with your clients, you want to make sure that what you're talking to them is actually suitable for their life situation. And a part of that is looking at the age of the kids and the Social Security blackout period. I want you to remember the concept of 16 to 65. That's the Social Security blackout period. That means that the family will be able to collect the deceased Social Security payments until the child becomes 16 years old, and then the check stops until the spouse becomes 65 or Social Security age. Okay. And of course, we know that that's going to change. We know that the blackout period could change. So I call it 16 to 60 or 16 to 65. But that's the Social Security blackout period. As long as you understand that concept, the age part won't necessarily matter. Retirement benefits can start as early as 60. So I like remembering 16 to 60. All right. Let's talk about business insurance. Remember KBE for business insurance. Business insurance. So think about, we have life insurance to protect our families, but what if we had businesses and business partners and stock? What if we were the key person on the team at the company? So if you're Steve Jobs in an early Apple, they need you, right? The company stock could tank if you passed away. All of your intellectual capital would be gone. The company is not in a position where it can run without you, and it would cost a lot of money to replace you. That's how you know that a person is a key man on the team. We're going to talk about that first. So key employee or key person. This means the business can suffer a financial loss because of the premature death of a key employee. And so the reason to buy, this is the reason to buy this insurance, is to protect the business from the loss of the key employee. The employee is the insured. The business is the payer and the beneficiary of the policy. The policy owner is the business, but the insured, remember, has to be a human life. The insured is the human person that we're talking about, okay? The business is the applicant. The business is the policy owner, the premium payer, and the beneficiary. And so because the business is the beneficiary and the premium payer, remember that the business cannot write this cost off on its taxes. The business cannot write this cost off on its taxes. There is no tax deduction there. Because they get the money when the key person dies, they'll get that check tax-free. They're the beneficiary, okay? So in the buy-sell funding, that's another type of business insurance. Remember KBE, the B is for buy-sell funding. And this is a legal contract that's backed by insurance. So basically my business partner and I, and this is an oversimplification, y'all, but I want to help you pass this test. My business partner and I have insurance on each other. God forbid something happens to me, that contract is now backed by insurance that says my family will get paid and the business partner will get my part of the company. And so it's a contract backed by insurance. And there's several ways that this could happen. It could be cross-purchase, where it's used in partnerships. This is one thing you'll see a lot. Another one that you'll see a lot is stock redemption. This is where the money from the life insurance is used to redeem that share of stock. Used to redeem that stock value loss. Okay. And then the E is for executive bonus. So there's another type that we're going to talk about. This is where executives can be compensated in their salary package using life insurance. Now, the life insurance is for the personal benefit of the family. So this is not key employee insurance. That's for the benefit of the business. This executive bonus insurance is like getting a part of your pay in the form of life insurance. It's tax deductible to the company because the company is not the beneficiary, but it is income taxable to the employee. So it's just like a part of your pay. So let's talk about the process. All right, so we get down to the nitty gritty. There's a 4-step process for the selling, the issue of a life insurance policy. I like to remember SUP, S-U-P-P, SUP. So there's the solicitation part. This is like the sales process. This is the persuasion part. This could be TV, face-to-face. It's an attempt to persuade somebody to buy. Then there's the when you go down and into that process, there's advertising. Then remember, advertising must be kept on file for 4 years. The reason why I like to integrate some of the other concepts in with these is because it'll help you remember them. And so your advertising must be kept on file for 4 years or until the next examination by the state. And the company is responsible for all the advertising that you do. So you have to be so super careful. I don't care what your friends say. This is one sidebar. Tyra's about to go on a rant. I've had people tell me over the years, Tyra, you really should push yourself more. You should push your brand more. I read the regulations and I know that there are a lot of things that I cannot do and I cannot say. I can't put my testimonials out there. I can't say certain things on social media. I can't get out there and push my brand all day and talk about the results that I'm getting for families. I can't make income claims. So whatever those regulations are, you got to make sure that you continue to follow them, even when the trend says that you should be doing something else. You don't want to lose your license, lose your ability to help people and help your own family following some trends or listening to people who are not in the industry and don't damn know. So be sure that you're not out there writing your own advertising unless it is approved, because regardless of who wrote it, the company is responsible for your advertising. And then there's a buyer's guide during that process of solicitation. There's a buyer's guide that's given to the client. A buyer's guide is generic, not specific to the policy. It's generic and it talks to them about life insurance, general information. It helps the buyer compare policies. And then there's a policy summary. The policy summary is specific to the policy. This is why it's different from a buyer's guide. Buyer's guide, generic. Policy summary, specific to the policy that's being issued. And it'll include things like the premium, the cash value, the dividends, any of the death benefit figures over policy years, any of that kind of stuff. And illustrations. I want you to think about illustrations as non-guaranteed values, like an illustration in a book. It's not a real person. It's just an illustration of a person. This is the exact same way. Illustrations that you see in a policy can have non-guaranteed values. It's not real. It's kind of like a storybook.